Testing.
Okay. Excellent. So welcome, everyone. I think we have a few people still coming back, but we're very excited to have this panel today to talk to you about closing the protection gap here in the U.S. So I'm Alessa Kwan. I am a Drake grad, 1992, and I am the Chief Insurance Officer at Oscar Health, which is an ACA Affordable Care Act health insurer. So today, as we talk, and I'm going to let my panelists introduce themselves in just a moment. But I thought to just sort of set the stage to talk about the protection gap here in the U.S., I would give us a few facts. So as of right now, approximately 30% of U.S. households are underinsured, which means they don't have, the sufficient coverage to meet their needs in the case of a disaster. About 8% of Americans have no health insurance, according to the Congressional Budget Office. 40% of American adults do not have any life insurance, and nearly 70% of those with coverage have insufficient amounts to actually cover their financial obligations. And about 40% of Americans would struggle to cover $400 of emergency expenses in the event that something unforeseen happens. So as you can see, there's a real gap from a financial perspective for the majority of Americans here today. And so we have three panelists from different elements of the insurance industry to talk to us about how insurance can help to close some of those gaps. So I'm going to let each of you introduce yourselves first, and I'll start with you, Eric.
Very good. I'm very happy to be here. My name is Eric Rybczynski. I'm an Executive Director of Strategy and Innovation at the Reinsurance Group of America, or RGA. I've been with RGA for about 7 years now. I hired into RGA, into their RGAX Innovation and Venture Capital arm. That has since been rolled into the business, but still very much alive, just closer to the business. Part of my role now in the Americas, doing a lot of innovation in terms of working with our business segments. So at RGA, we're focused solely on life and health. So we have individual life, we have group life and health, we have individual long-term care, individual disability, other businesses. The Americas consists of the U.S., Canada, Mexico, and various countries in LATAM and SouthAm. I help our business segments identify problem statements that their clients are trying to solve and help find innovative partners to do that. Also, as a large component of my roles, partnering with venture capital firms through our investments team to understand if we don't have it, if we can't build it, where can we go source it. And yeah, so it's been good. Also, strategic objective setting. I want to kind of highlight what Alessa said and touch on some statistics from a life insurance perspective in terms of the gap. Alessa mentioned only 40% of individuals have life insurance. The sobering statistic that really shows some impact of that is about, this comes from LIMRA and Life Happens recent insurance barometer study, is that 25% of respondents said that they would experience financial hardship within 1 month of the primary wage earner passing away. And almost 60% of respondents indicated that they would experience financial hardship within 1 year of the primary wage earner passing away. So clearly this is a coverage gap that we'd like to close. The study also showed that about 40% of those surveyed intend to buy insurance. They'd like to. They think they need to buy more. But the study has shown over the past few years, insurance ownership, life insurance ownership has remained largely flat. So intention doesn't correlate to action. But we'll talk a little bit today about the things that we can do to help close that coverage gap.
Thank you.
Perfect. Matt Young, I lead Swiss Re's U.S. property treaty underwriting team, so maybe a primer on reinsurance. So it's been talked about a few times. It's a little bit different in the property space. So reinsurance is insurance for insurance companies, of course. In the property world, unlike in the last couple panels where we've talked about like transfers of entire books of business, in the property world, that often looks like a property catastrophe treaty, which means transferring a company's the risk from a single catastrophe event to a reinsurer. And treaty would just mean the entire portfolio of risks. So for a national carrier, they write billions of dollars in insurance premium. Maybe they can retain a couple $1 billion for any one, say, hurricane or earthquake, but they want to transfer some of their tail risk so that they can protect their surplus. Compare that to a small single county or regional carrier that wants to compete with that large national carrier, but they really can't even write maybe a single risk without reinsurance. And so reinsurance enables them to, say, write a home or homes within their county and compete with the likes of a large national carrier. So when we talk about things like hurricanes, earthquakes, tornadoes, wildfires, winter storms, all of the above, that's what I'm responsible for at Swiss Re. As far as the protection gap goes, seems pretty obvious when we have large natural catastrophes. But in 2023, according to Swiss Re's research, there were $291 billion of economic loss globally, of which only $117 billion was insured, which means the uninsured portion is significantly larger than the insured portion. And our goal in closing the protection gap, it's not to reduce it to zero. There are reasons. Some losses can't be covered by insurance. There needs to be alignment with property owners and deductibles, so it won't be reduced to zero. But certainly we'd love to flip that so that we've got people who could be resilient and have insurance. One other recent kind of more local example of this was with Hurricane Helene. Florida's generally prepared for a hurricane. They know their risk, but Georgia, North Carolina, South Carolina, they were surprised. And just one example of the protection gap that's pretty striking, Buncombe County, North Carolina, which is where Asheville is, they have 140,000 housing units, and they have 941 NFIP policies as of the last reporting date. So less than a 1% take-up rate. And we'll get into some of the drivers of the protection gap, but that really illustrates what we're talking about. This isn't a small problem. This is a big problem that has real consequences for people.
Hi, everybody. I'm Dennis Hillen. I also am with Oscar Health, Senior Vice President with responsibility for our insurance strategy, product development, product implementation. New role for me. I just transitioned from a market leadership role where I was there for about 5 years, growing and selling product in the market, and then running the overall P&L. My path to Oscar and health insurance is nonlinear. My background is corporate finance. I was the head of finance for a medium-sized company, and and the way the system's designed, people like me were responsible for picking health plans for a group for the people that work for the employer. And one of my responsibilities is to pick the plan and the design. We had a low deductible, high premium plan and a high deductible, low premium plan. And so we offered those two things. And what I didn't realize at the time, with more corporate finance and insurance, is that by choosing for me and my family, the high deductible plan, I basically created a coverage gap. And my whole experience with that is what got me into health insurance, because there's a lot of choices that go into your health care, whether it be lifestyle choices or choices you make with your physician or your clinician that impact costs in ways that are completely obscured to the average consumer. I didn't realize that going in, and just how far consumerism is from where the health industry is today. But it's really, really important. I think many of y'all may know that the healthcare industry, and the fact that it's even called an industry, is kind of mind-boggling. But it's about $4.5 trillion, right? That is massive. If it were a country, right, it would be probably the third or fourth largest country by GDP in the world. And how that then relates to protection gaps, of that, about $200 billion is medical debt. So think of this as though people who can't afford the care that they receive that sits outstanding. That then leads to, depending on what research you see, what studies you see, anywhere from 40% to about 2/3 of bankruptcies are as a result of medical debt, because unfortunately the cost of medicine can be very, very high. The cost of hospitalization can be very, very high, and that's where insurance should come in. But despite all the things that have happened from a regulatory standpoint and all the laws and things that have happened, as she mentioned, 8% of people are still completely uninsured that are being exposed to things like this. And so I was in a very different situation, but I learned about deductibles, I learned about plan years, I learned about how to save in an HSA, and I've decided, was kind of called to the industry to try to figure out how to simplify this for consumers so that they aren't presented with what I was pretty fortunate to have saved an HSA to cover that gap. But as you can tell by the numbers, many people aren't. And so what happens is that then exacerbates health conditions, right? It creates a wedge between people and how they engage with the healthcare, profession in the industry and their physician, because they view this economic barrier that ultimately affects them, affects their ability to provide for their family, to continue to work, and ultimately live a life that they want to live.
Great. So Matt, I'm going to start with you. What are some of the key drivers that create the protection gap that we see today sort of in the property space? And are there any innovative strategies that you think insurance providers could implement in order to help close that, particularly when we think about underserved communities? And is there any way that technology plays a role in this transformation?
Yeah, that's a big question. So I'll focus on a couple different pieces. So I think there's two drivers of the protection gap from a property perspective. The biggest one in my mind is an unawareness of risk. So of the losses that I had mentioned earlier, oftentimes we think of the developing world as, well, that's where the protection gap is. The reality is the largest protection gap is in the United States. There's a lot of people that go without insurance for whatever reason, but they may make the choice or they may not know of their risk. The rest of my comments, if people know their risk and they've made the choice, I'm willing to self-insure or whatever reason, that's a conscious decision that's made with education, and that's okay. The other side of it, though, is not being aware of your risk, and that's the hardest part. And kind of mixing that with, what are the innovative solutions? Sometimes I think they're innovative, and sometimes I think they're just kind of like common sense that sometimes we forget about. But when I think about awareness of risk, and you go back to, say, Hurricane Helene or any flooding example that you can think of, a lot of people will say, well, I wasn't in a flood zone. I wasn't supposed to flood here. And if you think about how we communicate flood risk, we say, well, FEMA has these flood zones, and if I'm not in the flood zone, I'm okay. And if I'm in the flood zone, well, then I'm just forced to buy flood insurance. Those flood zones, they're communicated as, well, a 1 in 100 year event is a high risk flood zone. And you say, 1 in 100 year? What are the chances of that happening? And well, what that actually means is you have a 1% annual probability of being flooded. You put that in terms of maybe over a 30-year mortgage, and of course it's much higher than that. And we've seen numerous instances where we've got huge losses that are coming, and people just say, I wasn't in a flood zone. In Hurricane Ian, we saw it on the east side of Florida, where heavy rainfall, it doesn't know any flood zones. In Hurricane Helene, again, we saw it in the Carolinas and Georgia. We repeatedly see that. So I think we can change how we communicate risk. Not you're in a 1 in 100 year flood zone, or you have a 1% annual probability of loss, but maybe what a loss would look like at your property. So the example I cite is the Weather Channel. So when they're talking about storm surge coming in from a hurricane, the Weather Channel will like superimpose where the reporter's standing with what a 30-foot storm surge might look like. And of course, it's over the top of most of the buildings and just would be pure devastation. It's really hard for us to imagine like what would a 30-foot storm surge without that illustration. So when I think about like what are some of the innovative things that we can do to close that protection gap, it comes down to communicating risk in a way that is relatable. I think the other thing goes into that. It's never happened to me before. It's not going to happen again. It's never flooded here. I can't tell you how many times we've heard that. Now translate that to wildfire or any other loss. Earthquake is another one that's interesting, where in flood, people generally, in my view, don't know their risk. Earthquake, people kind of accept their risk. So they say, well, I've got a big deductible, I get a relatively low limit, and the premium's high, so I'm just willing to accept that risk. I think that at least is a conscious decision. I think the other piece is like the changing nature of events. And oftentimes we say that and we think of climate change and all of that. But actually it's far more than that. And sometimes when we say climate change, we're like, well, that's a big problem, and there's nothing that we can do like right now individually to address that. That's just an unsurmountable problem. What we actually see, and we can put into numbers, is that the changing nature of the risk, it has something to do with weather patterns. It also has a lot to do with changing nature of our habits. So whether it's construction in an area like Houston, or urbanization in most urban cities, but there's a striking example in Denver, where if you look at a satellite view from 15 years ago versus today, you very clearly see the number of rooftops and the urban expansion and what that means for any loss that's going to come through. So between the urbanization and some changing weather patterns, you kind of can really quickly see how the protection gap just continues to be exacerbated. And then technology, you asked about technology. I think that just plays a role across. So technology helps us to better understand what these events can do. It helps us to better illustrate what the effect can be, like the example I had shared. It also, so the First Street Foundation is a group that does some really good work in risk awareness. They started with Realtor.com. They're, I think, now on Zillow more recently, and will give a risk score for given locations, which people have to take the active step to actually look at it. But I think that's a really good start into what can technology do to kind of start to raise that awareness.
Thank you. Dennis, let's move on. What do you think are some effective approaches that could address the protection gap in the health space? And in particular, with a focus on making sure that we get what we always refer to as, health equity and accessibility for more vulnerable populations.
Yeah, there's a lot of things out there that have helped this. So the Affordable Care Act is one of those things. It was designed basically to help fill in the gaps between Medicaid and people who then aren't on a group plan, who either aren't aware that they can get insurance through an individual policy, or prior to the Affordable Care Act were unable to because they weren't guaranteed issue, they were individually underwritten, and could be very costly for someone with pre-existing conditions. And so that was one of the things that was weighed with the ACA. So a lot of the foundation is there now. If you think about across the board, depending on your economic status and your where you may fall from an income standpoint, it really comes down to education. It's a product that generally speaking people don't line up to buy, right? Regardless of, and you don't think about it really until, and oftentimes many people get enrolled when they show up and you go to a hospital and they say, oh, who's your insurer? Naturally, and at least if it's an emergency, most hospitals in the U.S. have to provide care, but they still, that's the point where they check and they'll say, okay, they get into the background, they have someone who helps them with that. That's way too late for a number of reasons. And you talked about health equity. So that's one thing to say, all right, how do we think about this from a financial perspective? But the $4.5 trillion I was mentioning is really the effect, oftentimes, of people who haven't been engaged in their health for whatever reason, and the costs have just exacerbated. Think of chronic conditions that are unmanaged. Think of people going to an ER when maybe an urgent care would do. And so there's a lot of education of how to engage the healthcare system properly. And when you think about the product of health insurance, it can be the leveling factor. So once you make that decision, you can engage with someone who can help unlock community assets that might be available to you, help make sure that you have a relationship with a primary care physician. What's interesting about health insurance is it's one where we encourage, as an industry, utilization. It just has to be appropriate utilization. So if you think about the way the benefits are designed, we have some plans that are designed for people with certain conditions, removing any financial barriers between them and whatever they need to manage that condition. So we have, for some of our members with diabetes, we've designed plans that basically remove the costs of eye exams, remove the cost of primary care visits, remove the cost of all the things that they may need to help manage their condition. Put caps on the cost of insulins. These are things that are very specific. And so when you have a chassis now with the Affordable Care Act and a number of other health plans, they can be designed to understand what are the barriers that person might face that ultimately could lead to costs, but more importantly, that could make their health condition get worse. And how do we level that playing field? And so how this product ultimately gets rolled out is very specific. It's basically priced at pretty much a zip code level. So it's now our obligation to understand the people that we serve in those zip codes. What do they need to make sure that they can then have that appropriate utilization, that we can collectively manage their health, which they then manage their costs, which then ultimately creates societal benefit and helps manage that, and if we can, reduce that $4.5 trillion burden on our country.
Thank you. Eric, So, in the life space, what are some ways the industry can innovate to close the gap, and particularly if we focus on low income and the more marginalized communities?
Yeah, great question, Alessa. First, I'm going to speak to some of the challenges in those communities. Typically, if we're talking about low-income communities, marginalized communities, these individuals might have jobs, but these jobs typically don't come with, say, employer-paid life insurance. So they're already starting at a coverage gap. That unfortunately is probably like the base level of life insurance for most Americans who are employed. They typically don't have the incomes for them to support a premium payment, so their discretionary income is not really available. And thinking about just the communities that they live in, there is not broad access to financial education, to advisors, to wealth managers, to agents. So just the education around financial protection isn't there. So a number of systemic issues just preventing them from getting that coverage gap closed and really starting from a bad position to begin with. Also, just due to some historical discrimination, especially in communities of color, there is still some persistent distrust of the financial services industry and insurance overall. These are all things we need to overcome. There are also some unique challenges when considering underwriting these populations, just health issues due to socioeconomic factors, just the locations that they live in terms of potential crime, some substance abuse factors. These are all kind of like play into the fact that make it somewhat difficult to close that coverage gap. So what are some of the things that we can do then? Obviously, education is probably the foundation, is educating these communities on the importance of financial health and wellness, saving versus spending, just wealth management to start. Like before you even kind of get into like protecting wealth via insurance and transferring wealth to your family should something devastating happen, they need to understand the concept of wealth management and building wealth. Also need to consider, okay, how do we communicate that financial awareness? Again, I mentioned unlikely to have really a broad network of banks, financial advisors. Some of these communities are kind of wealth management and banking deserts, unfortunately. But ways that we can access these communities, especially younger ones, is through social media. The LIMRA study that I mentioned previously showed that Black communities and Asian communities in particular really put a significant emphasis on influencers online. And so if financial institutions like insurers can partner with some influencers that are relevant to those communities, I think it'd be a really great place to start and help increase the awareness of financial education, wealth management, and insurance. Also, product design. A lot of life insurance products today are really tailored to higher net worth individuals. There's an opportunity for us to go down market a little bit more and offer more relevant products and innovate there. And the industry is trying, but selling those products, administering those products, like the dollars don't always make sense. But it's something we need to look at, and I think embedded insurance is one of these examples where you can start putting some very small policies embedded with other products, say like a mobile service plan, phone plan, if you have a bank. And unfortunately, these communities are typically underbanked, so that can be a challenge. This thinking of things that these communities, these individuals in these communities use often, can we embed, even if it's a small life insurance policy, but it does increase stickiness for those products as well. And I think overall, the industry isn't very well represented by people of color. We don't have enough Black wealth advisors, Black insurance agents, Hispanic or Latino agents and bankers. And I think the industry as a whole can get better about continuing to promote DEI, getting more individuals in the space, and getting people in these communities to help distribute insurance.
I think that's a really good point. And I think the first panel this morning, there was also this discussion. Those were a bunch of risk officers talking about people in their company sort of trusting them. But I think a big part of the education that each of you sort of hit on is the right people, educating people that they trust, that they're speaking to, et cetera. Dennis, is there anything that you would add in terms of this education theme and ways to go about pushing that forward?
Yeah, absolutely. Yeah, it's a great point about I mean, it's basically the different communities that need to be reached. And so some of the thinking we've been doing on this and the program development and how we're focusing on products is starting to build our products and our experiences around those. So as an example, you mentioned the Hispanic community. One of the things that we've built is a end-to-end Spanish first experience, something that we call Hola Oscar. Now, there's a lot of nuances within the Spanish-speaking population, but at a minimum, if you can ask someone, what is your native language in the buying experience, and if it just so happens that the broker who sells that plan is also Spanish-speaking, then their entire journey, all the way through then how we can help facilitate their connection with the provider, if we can get data on them, do they also speak Spanish, then they don't have to navigate a very complex system in a language that's foreign to them. So to the point about, there's education, we also have to make sure that what we're educating actually relates to them and who they are, and how their community, approaches health, at least in healthcare, and I think it relates to some of the other products as well. So it's really about meeting where they are, to the point, and using, product innovation and really understanding these different segments if we want to serve them appropriately, understand how they want to be served, not only what their problems are. I think there's a lot of common problems, but how they get solved and what are the unique barriers they may face. It's got to be communicated in a way that relates.
That makes a lot of sense. We touched a little bit, well, Matt touched a little bit on sort of the use of technology and how it could enable developments that would allow us to sort of close that protection gap. What are some other things that you guys have seen and where technology could actually play a role in this?
I can start with that. One of the interesting examples I saw is like hyper-local advertising, but it all goes back to the education component. So in this specific example, you can get flood loss information. I'll stick with that example. You can also get, say, fire service calls in particular neighborhoods. So whether it is a natural catastrophe or something like just fire, you can then say, did you know, some sort of marketing material, did you know that in your neighborhood or in your zip code or in your community there have been X number of events and the average loss has been this? Have you considered, or are you adequately covered for whatever peril, for flood or for fire? The other piece is with building valuation. So I left it out earlier to simplify my answer, but one of the sources of a protection gap is, do you really understand how much loss you can suffer, whether it's this building we're in and has Drake assigned the appropriate building value to it, or is it your home? And a lot of times we see that, say, home values are going up and the replacement cost in your insurance policy is maybe higher than you think maybe the market value is. Well, your insurance company wants to make sure you have adequate valuation, not only for rating, but so when you have a loss that you can cover the loss of a total loss and the debris removal and all of that. And so I think that's where technology can come in and kind of show all of that. I think on the education piece too, maybe just going back one answer, we need to find trusted advisors to do all of this. So technology is really great, but it's still not a trusted advisor in most instances, I would argue. And so if your insurance company, we had done a study with an insurance company that was on auto, but sent letters in advance of a renewal and said, hey, for the following reasons, your insurance premium is going to go up or down at your next renewal. Here's why. If you have questions, please call your agent. That was the test group. The control group was just sending out the premium notice like most insurance companies do. And maybe it's no surprise, those that actually got an explanation of why their insurance premium was changing renewed their policies at a higher rate. So those are ways we kind of talk about innovative. That doesn't happen that often. Maybe it's just low-hanging fruit, common sense, enabled by technology, certainly. But then if you add into, say, that letter, a trusted agent, or in the home buying process, your realtor is often a trusted person. I think the technology and the education, it's more than just our industry doing the education. I think that's maybe the hardest part, especially with property insurance. It's not just the insurer. It might be the agent, the realtor, the home builder, whoever it may be. There's a lot across the value chain.
Yeah, so in healthcare, technology is critical, especially as everything is moved from paper to digital. The sheer volume of data is just mind-boggling when you look at the amount of healthcare data. And to make that worse, you have HIPAA, you have privacy, you have things that this data is it has to be protected at utmost cost because it's ultimately, you as who you are. It's some of your most sensitive data. So you have that component where, one, it's got to be the safeguard for what's this trusted information that consumers and our members and that as patients have trusted the system with, that we have to protect it. And then you have to put all that data into context. So if you think about if someone's navigating the healthcare, their healthcare journey, you have all of your record in theory, you have all of your family history, you have all of the possibilities, then you have the cost, and you have all these things that hopefully can be introduced to you in the moment where it's important, where you're making a decision. A decision with your clinician, a decision with your family. There's nothing else other than technology that can bring all that together, and meet someone where they are, to try to educate that moment as much as possible, or support that moment as much as possible. Because oftentimes when people are in the healthcare system, they're completely irrational, right? At least I am. Especially when I'm sick, or my wife will tell you I'm the worst patient ever. But or if my family's sick, like rational decision making goes out the window, which by the way means economic theory goes out the window, especially when you think about how imperfect data is in healthcare. So technology is going to be what brings that back and grounds you and say, here's where you are, here's what you need to know, make the right decision for you and your family, but we're bringing all this to you. So that we think technology plays a key role in making sure that people can navigate a super complex system with imperfect data in the moment they need it.
Yeah, regarding life insurance, technology has become incredibly important, and probably no area is embracing it more than underwriting right now. Dennis mentioned data, just the availability of data, electronic health records. If you wanted to get a life insurance policy, say 10 years ago, if it was of any significance in terms of face value, typically you'd have to have a nurse come to your house, you'd have to pee in a cup, you'd have to give blood, you got to do all these tests. Nowadays, you can get a life insurance policy like in 15 minutes. If for certain individuals, certain policy levels, just by consenting to have your data pulled from existing electronic health records, other sources of information, financials. That's the opening up of the data ecosystem and technology that has enabled electronic underwriting, and systems around it has been a game changer. Furthermore, RGA has a partnership with a company called Digital Owl, and really starting to bring AI into that space, and looking at health records which might not be electronic, might be handwritten doctor's notes from 20 years ago. Those can all be consumed and with optical character recognition converted into structured data, can fully kind of make diagnosis recommendations, diagnosis from an underwriting standpoint, like identifying things that underwriting needs to be aware of, and really can help underwriters quickly make a decision. And automated electronic underwriting has enabled direct-to-consumer digital distribution as well. So, like I mentioned, you can go online and buy a policy. That was not possible if a nurse has to come to your house. But with electronic data and what we can do with it, it's really kind of changed the game in terms of how we distribute insurance, and how well we can underwrite it and also price it. So along with this Digital Owl partnership, we're looking at taking all of the underwriting data we've had in the past, that we have, like obviously as a reinsurer, we have a wealth of data, and being able to look at that anonymously, but just kind of understand in aggregate how we've fared from a mortality standpoint based on how we might have underwrote something in the past, what data was available, and that really can help us moving forward in terms of pricing that risk in the future based on all that historical information, which would take a trove of people to have done by themselves. But now with AI being able to comb through these data sources, it's wonderful. And really, AI, and particularly Gen AI, is really going to transform a lot of parts of this field, I believe. Underwriting claims, we're seeing Gen AI become capable of multimodal generation. So basically take in all types of media at once: videos, pictures, documents, written text, been able to pull it all together, decipher it, and generate content. And that can be generating underwriting insights, or even an underwriting decision could be generating a claims decision based on all claims information available. You're really going to start to see that impact our industry, and probably going to impact P&C and health as well.
And Eric, maybe if I build on that, I started out my answer with technology thinking about the education component, but I think the underwriting component is equally as valuable because, like you said, all the publicly available data sources allow for maybe simplistic rating or opening up new products that didn't exist before, whether it's understanding how flooding works better, or in an auto sense, some regulators are less excited about, say, insurance score, but maybe we can accomplish the same thing by looking at like a population per square mile and deer population per square mile or something like that. So you have much more maybe not person-specific rating factors, which is a interesting experiment.
Yeah, I think there's other ways that technology also assists with accessibility. So, like if I think about post a large disaster, it used to take weeks, if not months, for claims adjusters to be able to actually get into places in order to come to start to get payments to people who need payments just for additional living expenses, to be at a hotel or whatever the case may be. And now the use of drones to be able to survey the property to understand what the situation is has been super helpful. If you think about the rise in the use of virtual care in the healthcare space, that started pre-pandemic, but certainly took off during the pandemic. But this is a way for people, one, to actually get care who might have otherwise just not gone and seen a doctor, or because they didn't have the time, they had to take time off of work, and might have had to take a whole half day in order to actually leave, go to the doctor, what have you, versus like a quick 10-minute thing on their phone with the doctor to discuss. So I also see technology create real accessibility for people to actually help in protecting themselves. So we wouldn't be a good panel if we didn't ask about regulation. And so what role do you think that various regulatory frameworks will play in either alleviating the protection gap or exacerbating it?
I'll start. I would say from a life insurance standpoint, and probably applies to kind of wealth advisory as well, as just regulations that drive transparency. We mentioned, kind of the potential mistrust in the industry. So product transparency, regulation transparency, how these things are marketed, anti-discrimination practices. Obviously, regulation there is helpful in terms of getting the benefits of insurance communicated to more people, and it being trusted information. I think that's those are opportunities to alleviate the coverage gap. Also, just regulations around how people's data is protected, et cetera. So, but that also, if there's too much regulation about data usage, that can also hurt the industry. So I mentioned the use of data for underwriting. The U.S. has pretty generous rules for what we can do with data, which is great because it really can benefit the consumer. The more that you consent to share, the better we can underwrite you. But there are some regulations. Some state by state, insurance is regulated state by state. Some states are getting more prescriptive or restrictive about what data can be used. And the intentions are good. They're trying to protect their state citizens, but they also end up harming others who that data would benefit from an underwriting standpoint and could result in more cost-effective products. And obviously that does impact the cost effectiveness of insurance for marginalized or low-income communities. So have to balance that in terms of like protecting the consumer, but also protecting the consumer from a price standpoint, because regulations can be burdensome, can increase costs. It's hard just to get into the insurance industry because of the regulations and the licensing required to be an insurer, to talk about insurance, to distribute insurance. Those all just drive up costs. And so, yeah, that's something to consider from a regulation standpoint.
At least from a health insurance standpoint, in particular the ACA plans, the subsidies play a major role, I think, in removing any protection gaps and kind of leveling the playing field, because the premiums and deductibles are on a bit of a sliding scale based on federal poverty, where people sit on the federal poverty level. And why that's important is because that way, whenever people who have a hard time affording health care embrace the system or show up at the system, depending on how it happens. It's done in an organized way that's actuarially sound, and that then creates an opportunity to engage people in what health insurance is, and how to get more engaged in decisions. The alternative, without that product that's subsidized and organized through a government program, is these people likely are going to show up in an emergency room and incur a significant cost, put burden on the system, utilize care in the wrong setting. You guys have been in an emergency room. I know some of them advertise low wait times. It's still not the best place to go for most things, unless it's a true emergency, and puts additional strain on the system, additional cost on the system. That it's a balloon. It's going to be squeezed. It's going to be squeezed somewhere. Instead of in an organized way, you're going to have this super high cost utilization basically shift into the costs that people who are insured end up paying for whatever their treatment is, because the hospital ultimately one way has to cover their costs. So they play, I think, a role in just leveling the playing field, or at least making sure that whatever that gap is appropriate based off of income and based off of the ability to pay.
I would add, from a property perspective, I mean, the role of a regulator is always hard. I've seen innovation embraced in a great way. And I keep using the flood example because for 50 years, almost all personal lines flood insurance sat with the National Flood Insurance Program. And as we sit here today, over the last 5 years, the private market has been able to build a pretty significant private flood portfolio itself. That was entirely enabled by regulators. And now as a reinsurer, we have fewer direct contacts with them. But like in the flood space, there was not a conversation that discouraged that. I mean, regulators are aligned in wanting to close this protection gap. There's probably some in the room who could confirm that. Equally, we have to recognize trends so that we don't create a larger protection gap. And there's 2 states in particular, Florida and California, where that has happened. Florida and California are both uniquely disposed to natural catastrophe risks. Florida, obviously, for hurricanes, California for wildfire and earthquakes. What happened in Florida is you saw, I think the stats, something like 9% of insurance claims are filed in Florida, but like 80% of insurance lawsuits are filed in Florida. That has to be addressed. Now, it was addressed from a legislative standpoint, so not just a regulatory standpoint, but legislative. That can't continue on without creating a crisis, more than a protection gap, like an absolute crisis. California's in a similar spot where wildfires showed how bad losses could really be, and a lack of quick response to it, and capping rate increases as loss trend was just skyrocketing. So that's where I would love to see the trends maybe more quickly recognized. I understand politics plays into it in a big way as well, but I think we see the outcome when the industry and the regulator maybe aren't aligned. Equally, in the flood example, you see a great outcome when they are aligned.
Great. So I'd like to take an opportunity to open up to the floor for any questions that people might have in the last few minutes that we have for the panel. I think we have some microphones if you can, so people online can hear your question. Thank you.
I'm curious, when you reference flood insurance and FEMA, crop insurance is another similar one. I'm curious, quasi-philosophically, apologies, Chris Draper here in Des Moines from Meade. When you're looking at the coverage gap, how do you each evaluate where the balance should be between what parts of the gap should be closed by the government, what parts should be closed by the private sector? Like for example, on the life insurance one, if you're in a market where, like the majority of Americans, you actually have a negative wealth position, there's probably not a benefit in paying to protect negative wealth. Or if I'm looking at outcomes versus cost, where do you see that balance between raising the actual income caps on Medicaid versus being more innovative with the insurance space? Those are just 2 examples. I'm just curious, how do you philosophically look at that? How do you decide where you want to put that balance when you're looking at these products, considering the totality of the context of how they would be used in those communities?
I think, so in the flood example case, there's so much room to grow that I'm less focused on what should be borne by, say, the federal government, more so what's the opportunity for the private insurers. So very quickly the conversation on flood goes to, well, the private market's just going to steal policies from FEMA, and the NFIP is going to end up in a situation where they have the worst risks. the reality is, if you keep the NFIP the same way it's been for the last 50 years, which is perfectly fine at their 4 to 5 million policies, there is 95% of the market that the private industry can go after and not compete with the government. Now, certainly, there's going to be repetitive loss properties, extremely high risk properties, where the private insurance market, that's just uninsurable. That's not going to be able to be addressed by the private market. But I think, in the flood example, it's less for insurers looking at, well, what do I want the government to bear versus me, and more so just what's the opportunity for me in the 95% space that's just totally uninsured.
Yeah, it was a great question about if I understood the question correctly, about basically, where do you draw the water line on income for Medicaid versus Affordable Care Act and whatever. And there's a lot of state level nuance, right, in that. So depending on, the state conditions, I think the maturity of the providers, the equation you mentioned, outcomes over cost, right? That's the value equation in healthcare. And what I find is that states that have provider communities that have really, and by providers, sorry, it's a healthcare term. Clinicians hate to be called providers, but it's just the easiest way to describe, what they do in the system. But there's some clinicians who've embraced that, who've understood that, who've become accountable for that equation. And where that happens, I think you see that income level a little bit lower, so that there can be more room for payment incentives and payment innovation to basically reward good outcomes, good value outcomes, and that's the value-based care movement in healthcare. That there's just a lot of nuance by state because of they say healthcare is local when you're in healthcare, and it is hyper local. What works in one city versus another, depending on who the hospital system is it part of a national system? Is it local? Is it mission driven? Is it for profit? How are the doctors organized? Like this is the supply side of healthcare is enormously complex, and so trying to figure out where that sits requires a lot of local nuance. But ultimately, it's something that has to be figured out, basically to try to improve that value equation. If it's a world where it's just an entitlement program with no accountability, I think we just are exacerbating our problem, and there'll just be enormous cost pressures that just at that point that'll just continue to escalate whatever those rates are without accountability for outcomes and cost.
It's a great question. I'll just quickly speak to the life insurance side, which is not, obviously there's not a lot here from like a government mandated life insurance standpoint. There's not an entitlement program around it. I think, you guys have, done a great job kind of explaining like the impacts. Like if you think about what I mentioned, like in lower income communities, it's, or actually to start in terms of like the actual impact, like financial hardship, I think the government needs to consider like if individuals don't have life insurance and something happens, how is it going to impact support services? Like, is it going to impact communities that, or families that are now going to be going on to Medicaid where they weren't previously, going to require other social services where they weren't previously? Those kind of calculations are going to need to be made about whether we start to enforce the decision to have like a mandated life insurance cover. Somewhat parallel, you might have seen long-term care coverage, long-term care insurance in the news. I think Washington State passed a mandate that LTCI needs to be offered by employees. California is considering, a number of other states are considering it because they're seeing that long-term care costs are skyrocketing, and eventually it's an impact to the state in terms of care. So could come down the line one day for life insurance.
Do we have any other questions? Okay, well then I would like to thank Dennis, Matt, and Eric for your time today, and hope that everyone found it to be an engaging conversation.